George. I bring in George Tsilis to continue our conversation. And George, we do have some down arrows sort of tracking, this month that has been somewhat volatile, no doubt. I was saying how the NASDAQ is having its worst month since, March of last year. And you're looking at a name in tech that's actually has an up arrow. It's up over 10%, and that's Dell.
Yeah, if you actually look at Dell's report and their business and valuation, all of these factors really line up for a really nice move. And there's just an open higher and a continuation as we're talking here. But if you consider their business in terms of infrastructure solutions, servers, hardware, and all the way down to the NPCs for both commercial and enterprise use, but also at the PC level for consumers. Across the board, there was growth, and that's important. If you look at EPS, $3.89, that was higher by 45% compared to last year at $2.68, and they beat the estimates quite a bit, which were estimated to be around $3.52. Sales up 39% year over year at $33.3 billion, beating $31.9. And last year it was close to $24 billion. So we're talking about a 39% increase, as I mentioned. Now, if you look at the breakdown for their segments, infrastructure services were up 73% and server business up 123%. Those are two notable increased divisions, and they're guiding higher now for the server business for AI computing at 103% for the full fiscal year 2027, which they increased their guidance for next quarter to $2.90 a share from $2.39, as well as for the full fiscal year between $12.90 to $12.90 from $11.40. So essentially, they continue to increase their top line sales. Infrastructure solutions, it's a higher margin business versus computing and servers. That is where the growth is for Dell. And right now, looking at the adjustment for EPS, it's only trading around 9 times 2027's earnings. So one would say it's getting rewarded substantively here because it's cheap on a valuation basis. It's also growing exceptionally well.
Yeah, understood. All right. So good AI hardware demand, so different than our software conversations we've been having, with the IGV, for example, down 20% this year. And we turn this hour around, the NASDAQ is down in the 6th of 7 weeks. CoreWeave in the world right now down 18%. So while we're seeing some good news there for Dell, different story for CoreWeave.
Yeah, so you have to consider. I think this market is really punishing, stocks that aren't really, providing stable revenue as well as earnings. So if you look at CoreWeave, now they did miss on EPS. It was a negative 56 cents. The estimate was 50 cents. They did beat on sales, and sales growth is pretty remarkable at 110% at 1.57 billion versus the 1.55 billion. If you look at total revenues for the year, they denoted at 5.1 billion, up 168% year over year. But here's the thing: if you look at the targeted guidance for sales between 12 and 13 billion, it's pretty much in line to what was expected yesterday prior to the report on earnings. And they are again looking at the targeted CapEx to increase between 30 and 35 billion. So sales pretty much in line guidance wise, CapEx increase wise, but nonetheless, their current contract backlog is reaffirmed at 67 billion. But the situation I think right now is this market is punishing those that are not first profitable and second essentially are trading at high multiples, considering this name is not expected to be profitable even in 2027.
All right. Look, as you said, wider than expected loss, and Wall Street is not giving any passes now. It's very evident. And then you look at a name like ZScaler. Tell us about that.
Well, this one, interesting enough, another one of these names in the last 6 months, down about 37%. This is a cloud security and solutions and internet private access business that's getting wrapped up with the rest of the cybersecurity names and software names. If you look at the report, it was actually quite good. $1 was the number on EPS, up 29% compared to 78 cents last year, beating the 89-cent estimate. And also sales, $815 million, up 26% versus 647 million last year. So these were beats across the board. Free cash flow guidance increase, or free cash flow for the year increased 18%. As well as average recurring revenue guidance increased as well to 3.74 billion versus 3.7, and top line sales guidance increased fractionally to 3.3 billion versus 3.1. I think the kicker here is essentially, even though adjusted EPS guidance was raised to $4 from 382 for the full fiscal year, the challenge really lies in earnings multiple. The situation we're seeing with ZScaler is potential competitive threats from artificial intelligence, but also trading at around 35 to 40 times forward earnings. And so essentially, really good report, but nonetheless, it may not necessarily be enough to offset the earnings compression or multiple compression we're seeing in the name. But this one will be interesting because the report was really good. But nonetheless, if you look at the analyst estimates, Piper Sandler remains neutral at 185, and Needham has a buy rating of 180. So you got to keep in mind that these analysts are still bullish, but they're recalibrating their price targets based on earnings multiple compression.
All right, thank you so much, George Tsilis. Really appreciate it.